Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Virgin Galactic.
If you find our talks useful, please consider subscribe, like, and comment underneath. Imagine deliberately shutting down a business that charges, what, $750,000 for a 15-minute experience?
Right, just turning the sign to close.
Exactly. You have people lining up, their wallets are open, they're ready to pay, and you literally lock the doors. That is the reality of Virgin Galactic right now.
It's a highly uncomfortable transition point for them.
Yeah, because we are looking at a company that is trying to force an evolution, right?
Yeah.
Moving from this cash-burning research and development outfit into a highly scalable commercial spaceflight operator.
And that transition, I mean, that is the absolute hardest part of aerospace. The mechanics of moving from, building prototypes to operating a high-cadence commercial fleet, it completely rewires how a business functions. So we are going to unpack the technical setups, the very real financial risks on their balance sheet, and all the catalysts coming up over the next 12 to 18 months. Because if you just glance at the raw numbers right now, they look completely contradictory.
Oh, they look terrible on paper.
Right. So you have to understand the strategy behind the accounting, or you just, you miss the wealth building context entirely.
Yeah, let's start with those contradictory numbers, specifically the fundamental analysis. If you look at their Q4 2025 revenue, it genuinely requires a double take.
It does.
They reported $0.31 million. That's $310,000. And they missed analyst estimates, which, those are already low, expecting $0.41 million.
Yeah, it's basically a rounding error.
Right. For a company building a fleet of spacecraft, less than $500,000 in a quarter is nothing. It looks awful.
Well, it looks awful if you treat them like a mature company, right? But that negligible revenue is the direct result of an intentional pause. They made a very calculated decision to halt commercial flights entirely. Every single engineer, every dollar, every hour of factory time is being diverted to develop their next-generation vehicles, the Delta-class spacecraft.
So to put this into perspective for you listening, think about a highly successful theme park. Imagine this park just, closes its gates for an entire year to build the most revolutionary roller coaster the world has ever seen.
That's a good way to look at it.
Yeah, if you look at the park's daily revenue during that closure, it's zero. The financial statements look like the business is dead. But outside the gates, the lines are forming around the block, and management just dramatically raised the price of admission.
The theme park analogy really holds up, especially when you look at how they are managing their cash while those gates are closed.
Right.
Because the daily revenue miss, that's just a distraction. What Wall Street actually cares about right now is their operational discipline.
Okay, unpack that.
Well, while the top-line revenue missed, their earnings per share, their EPS, actually beat consensus estimates.
Wow, really?
Yeah. They reported a loss of 98 cents per share, which is actually significantly better than the expected loss of $1.12.
So they're bleeding less cash than analysts modeled during this massive downtime.
Exactly. They are tightening the belt aggressively. They cut non-GAAP operating expenses by 16% year over year as of Q3 2025.
That's huge.
It is. They know they have to extend their financial runway to make it to the launch of the Delta class. But going back to your theme park analogy, the absolute most important signal here is the pricing power.
Right, the ticket prices.
Yeah, they reopened ticket sales, and the new price tag is $750,000 per seat.
$750,000 for, what, a few minutes of weightlessness and a view of the Earth's curvature?
Pretty much.
The fact that consumers are eagerly paying that, that is a massive validation of the demand. They currently have a backlog of 675 reservations.
Just in there.
Right. When you multiply that out, you're looking at over $400 million in future revenue, just waiting in the queue, waiting to be recognized the moment commercial operations actually resume.
And look, that $400 million is just the floor. Management has laid out a revenue target that completely changes the valuation math here. They are projecting a ramp up to between $1.3 billion and $1.7 billion by 2027.
Wait, I have to stop you there.
Go ahead.
How on earth did they jump from bringing in $310,000 in a quarter to $1.7 billion in a single year? The math on that kind of operational cadence seems almost impossible for an aerospace company that is currently grounded.
It is an aggressive target, no doubt about it, and it relies entirely on high-frequency operations. But this is exactly where their competitive moat comes into play.
Okay, how so?
Well, if you look at a competitor like Blue Origin, they rely on ground-launched vertical rockets. That is the traditional way to get to space.
Like the big countdown, the massive launch pad.
Exactly. But vertical rockets require immense, incredibly complex ground infrastructure. You need the massive launch pads, you need extensive weather clearance, and you have significantly longer turnaround times between flights because of the sheer physical stress on those vertical boosters.
It takes months to reset.
Right. But Virgin Galactic took a completely different engineering route. They used the White Knight II carrier aircraft.
Ah, right, the air launch system.
Yes.
They fly a massive, custom-built airplane up to altitude, and that plane carries the spacecraft under its wing.
Exactly.
And then, once they hit the drop zone, the spacecraft is released, and it ignites its rocket engine in the thin air of the upper atmosphere.
Yeah, and the real advantage of that air launch model is that it enables rapid turnaround. It functions, well, it functions much more like a commercial airline than a traditional spaceport.
Because they just land on a runway.
Exactly. It requires far lower operational complexity on the ground. You don't need a heavy launch pad. You literally just need a runway. That rapid turnaround capability, that is the mechanical engine driving that $1.7 billion target.
Wow, okay.
Yeah, the Delta-class ships are being designed specifically to fly, land, get inspected, and fly again in a matter of days, not months.
But getting to 2027 and actually realizing that $1.7 billion that requires cold, hard cash today, the ships have to be built first.
They do.
Let's dig into the balance sheet, because they reported $424 million in cash and marketable securities. Though, to be completely transparent with you, a later update from Jefferies noted the cash position had dwindled to $338 million.
Yeah, it dropped fast.
That drop is a real-time look at the cash burn required to fund this Delta-class development. And stacked against that cash, they carry about $422 million in convertible senior notes.
The balance sheet is incredibly tight. There's no getting around that. They are in the middle of a capital-intensive infrastructure build, so, burning through cash is totally expected, but the margin for error is undeniably shrinking.
Right.
However, they didn't just sit on their hands. Back in January, they executed a really vital debt restructuring. They managed to push out the maturities on that debt, which essentially bought themselves the critical time they needed to finish the spacecraft.
But pushing the debt back is one thing, right? They still have to fix the leak in the boat.
And they are. If you look at their free cash flow, which is the actual cash leaving the business after capital expenditures, it is improving sequentially.
Okay, what are the numbers there?
In Q1 2026, free cash flow was negative $95 million. Now, that sounds alarming until you compare it to the prior year period, where it was negative $117 million.
Oh, wow.
Yeah, so the burn is slowing down. The financial bleeding is actually being controlled.
And that narrowing cash burn is exactly what Wall Street algorithms and institutional buyers track.
Absolutely.
Which brings us to why the stock suddenly exploded. Let's transition to the technicals and market sentiment, because the smart money is positioning itself in a way you really need to pay attention to. On April 6, 2026, the stock had a dramatic, high-volume breakout. It surged 18% in a single trading session.
An 18% daily move, that forces the market to pay attention.
Yeah.
That surge pushed the stock from the mid-$2.40 range right toward the $3 level. And for the technicians listening, it broke cleanly through the 50-day simple moving average of $2.57, which had been acting as heavy resistance for a while. Right. Now, it is directly challenging the 200-day simple moving average at $3.23.
But we do have to keep our perspective grounded here. Even with that explosive move, the 52-week high is $6.64. So at $3, the stock is still trading at less than half of its yearly high.
Very true.
There is significant room for multiple expansion. But what is really interesting is the fuel for that April 6th rally. The data flagged it as unusual volume. This wasn't just retail day traders buying a dip on Robinhood, right?
Yeah.
Institutions were driving that breakout.
Unusual volume is always the footprint of institutional buying. But what makes this specific technical setup so explosive is the short interest.
Ooh, yeah. Let's talk about that.
Right now, short interest sits at an extremely high 24.3% of the float. That means nearly 1 in 4 available shares has been borrowed and sold short by traders who are literally betting the company will fail and go bankrupt.
Let me explain why that 24.3% is so dangerous for the people betting against the stock. Think of short sellers as people who borrowed shares for a high-stakes game of musical chairs.
I love this analogy.
Right now, a quarter of all the chairs are borrowed. If positive news hits and the music stops, all of those short sellers have to buy back real shares at the exact same time to return what they borrowed. When they all rush the exit simultaneously, they drive the price through the roof. That is a short squeeze.
And the options market is flashing massive signals that traders are bracing for exactly that scenario. The options put-call ratio is sitting at 0.83.
Break that down for us.
Sure, a put is a bet the stock goes down, and a call is a bet it goes up. A ratio below 1.0, like this 0.83, means that call volume is actually outpacing put volume.
Got it.
So the derivatives market is literally tilting bullish. You combine 24% of the float shorted bullish options flow and heavy institutional buying volume. I mean, the powder keg is fully loaded here.
And the analyst community is starting to sense the shift in the wind, too. The consensus mood has been deeply bearish for a long time. The overall average price target is still $3.45 with the reduced consensus. But look at the recent forward-looking actions. Susquehanna just raised their price target from $2.50 to $3.
Yeah, and Jefferies is being even more aggressive. They maintained a buy rating with a $5 price target.
$5?
Yeah, and their thesis relies on the exact mechanics we just discussed. The free cash flow path is clearing up, the debt maturities have been pushed out, and if management actually hits the operational milestones for the Delta class, the current valuation is going to look incredibly cheap in hindsight.
But, analyst ratings are just talk. The real story is what the institutional whales are doing with their own capital. Let's look at the SEC filings from Q4 2025.
Let's hear it.
Millennium Management increased its stake by 118.9%. Quadrature Capital grew its holdings by 130.5%. Invesco raised its position by 52.9%. And in the quarter before that, Vanguard grew its position by 26.9%.
Funds like Millennium and Quadrature, they do not increase their positions by over 100% on a whim.
No.
They have armadas of analysts doing the math on the cash runway.
Okay, but I have to play devil's advocate here. If the $1.7 billion revenue target isn't coming until 2027, why are these funds loading up on millions of shares right now in early 2026? If the company is still just burning cash, why wouldn't these institutions wait another year to see if the spacecraft actually works before risking their capital?
Because in the stock market, you do not get paid for what has already happened. You get paid for bearing risk right before the uncertainty is removed. Markets are completely forward-looking.
Right.
If institutions wait until the $1.7 billion is already hitting the balance sheet in 2027, the stock price will already be at $15 or $20.
They'd miss the whole move.
Exactly. They are buying now because they see the de-risking events approaching. They see the cash burn slowing down, and they know the moment the Delta-class fleet proves it can fly, the existential risk of bankruptcy drops to zero.
Beyond the fundamentals, there are other psychological factors driving this sentiment, too. We saw a sector-wide sympathy rally recently, driven entirely by the anticipation of a SpaceX IPO. Whenever space exploration makes mainstream headlines, it acts like a rising tide that lifts all the pure-play aerospace names.
Oh, sentiment is highly contagious in this sector. But there is also a very specific speculative rumor floating around regarding industry M&A mergers and acquisitions.
Right.
Reports recently surfaced about Amazon being in talks to acquire Globalstar. That sparked a massive conversation on Wall Street about who else might be a target for acquisition.
Right, and because of Virgin Galactic's unique air-launch intellectual property, that White Knight 2 system, there is speculative chatter that they could become a niche acquisition target.
Yeah, it's fascinating.
Think about major defense prime contractors who are looking for rapid response suborbital platforms. If you're a defense contractor and you need to get a payload to the edge of space with 24 hours notice, a vertical rocket launch takes way too long to prep. An airplane that can drop a rocket from 50,000 feet is incredibly valuable.
And we really have to emphasize that this is strictly unconfirmed and highly speculative chatter. But it serves a purpose, right? It highlights the underlying value of their intellectual property. The technology they hold is valuable beyond just taking wealthy tourists on joyrides to the edge of space.
So the institutions are piling in, the squeeze setup is primed, and the IP is valuable. That means we need to map out the actual events, the catalyst, that will determine if this stock ignites or collapses over the next few months. Because this is a make-or-break timeline.
It really is.
Yeah.
And the first major catalyst is happening right now in April 2026. The company is conducting Delta-class spacecraft ground testing.
Now, to be clear, this is not a flight.
No, it's not a flight, but it is a critical engineering milestone. If they successfully complete this ground testing, it serves as a massive de-risking event. It proves to Wall Street that the hardware is on schedule and the engineering is sound.
Following that, we look to early to mid-May 2026 for their Q1 earnings report. Now, investors aren't going to be looking for top-line revenue, We already know the flights are paused.
Right.
What they will be scrutinizing is the cash burn rate. Did they keep the cash burn below $95 million? And they will be watching to see how well that $750,000 ticket price is converting into hard reservations. Are the wealthy still lining up?
We also have to zoom out, and look at the broader macro environment. We are currently seeing cooling inflation and the very real potential for interest rate cuts.
Yeah.
For a high beta, long duration growth stock like Virgin Galactic, rate cuts act as a massive structural tailwind.
Explain the mechanics of that for us. Why do interest rates impact a company that isn't even making money yet?
It basically comes down to the discount rate. When analysts value a growth stock, they are modeling cash flows that won't happen for years, like the $1.7 billion projected for 2027.
Right.
They have to discount that future money back to what it is worth today. When interest rates are high, future money is worth less today, so the stock price drops. But when interest rates get cut, the discount rate falls.
I see.
Suddenly, that $1.7 billion in 2027 becomes much more valuable in today's dollars, driving the current stock price higher.
Okay, so that is the upside scenario. But we have to soberly address the existential risks here. If execution fails, the downside isn't just a 10% drop, it could be total devastation.
Yeah.
We have to talk about the liquidity cliff.
This is the absolute core of the bear case. We discussed the balance sheet earlier. They have roughly $424 million in cash against $422 million in debt. The entire strategy hinges on commercial service resuming in Q4 2026. That launch date is a binary event.
Binary meaning it either works perfectly or the company falls apart. There is no middle ground.
Exactly. If they hit the Q4 2026 launch date, the stock likely re-rates significantly higher. But if there is an engineering delay, say, a testing failure pushes the launch into mid-2027, they will simply run out of financial runway.
They just won't have the cash.
Right. They don't have the cash to survive an extra 6 months of zero revenue. They would be forced to either execute severe equity dilution, issuing millions of new shares and just crushing the value of current shareholders, or face a total liquidity collapse.
Which perfectly explains the valuation debate happening on Wall Street right now. Morgan Stanley maintains an underweight rating on the stock with a $2.30 price target. Their argument makes total sense when you look at the current multiples.
Oh, for sure.
The stock trades at an enterprise value to sales multiple, or EV sales, of 34.3 times. Because they aren't profitable, looking at traditional price to earnings is useless. We have to look at EV sales.
Right.
And a 34 times multiple sounds terrifyingly high. It means investors are paying $34 for every $1 the company currently makes in sales. Is that premium entirely dependent on flawless execution of the Delta class?
That is the exact crux of Morgan Stanley's bear argument. They are saying the current price assumes nothing goes wrong, and in aerospace, well, things always go wrong.
Always.
But there is a mathematical counter-argument to that valuation premium. The premium is heavily tied to the optionality and the projected growth of the sector itself. Analysts project a 44.8% compound annual growth rate, or CAGR, for suborbital tourism through the year 2030.
A 44.8% annual growth rate is explosive. Very few industries on Earth are growing at nearly 45% a year.
And that massive growth is exactly why the multiple is a bit misleading. If you believe management can scale the Delta-class turnaround times and actually hit that $1.7 billion revenue target by 2027, that terrifying 34.3 times EV sales multiple compresses instantly.
It vanishes.
It vanishes. The multiple is only high if you assume their revenue stays flat at $500,000 a quarter. If revenue scales to $1.7 billion, the current enterprise value is actually incredibly cheap. That is why the improving free cash flow we saw in Q1 is so vital. Management is stretching every single dollar to ensure they survive long enough to see that multiple compress.
We've covered a tremendous amount of ground today. Let's synthesize all of this, the fundamental strategy, the technical squeeze setup, and the stark liquidity risks into a clear, actionable thesis for your wealth building strategy.
Based on all the data, the bullish score for this setup is a 7 out of 10.
So, what is the elevator pitch for you listening right now?
Virgin Galactic is standing at a historic inflection point. This is a multi-year turnaround story. They're finally transitioning from a cash-burning R&D project into what could be a highly scalable commercial operator.
Yes.
The fact that they can close their doors, build a new ship, and still sell tickets at $750,000 proves they have immense pricing power. It secures a backlog worth over $400 million. And yes, the risks are undeniably elevated due to the debt load and the ticking clock of their cash burn. But the improving free cash flow metrics and the heavy institutional accumulation from funds like Millennium and Quadrature, Those are powerful signals.
Very powerful.
The smart money believes the financial runway is stabilizing and that they have the cash to make it to the critical Q4 2026 Delta-class launch.
So your target horizon here is a multi-year hold. You are positioning yourself for a binary re-rating of the stock over the next 12 to 18 months, heavily dependent on that Q4 2026 commercial launch.
Right.
If they fly on schedule, the upside, multiple expansion, and the resulting short squeeze could be absolutely staggering.
Yeah.
If they delay, you have to be prepared for the dilution risk.
You are balancing the extreme risk of an aerospace hardware delay against the potential of a massive, squeeze-driven breakout fueled by that 24% short interest.
Before we wrap up, I want to leave you with a final thought to mull over. We've spent this entire time talking about $750,000 tickets. The market currently treats Virgin Galactic as a luxury space tourism brand for the ultra-wealthy.
Which it is, currently.
Right. But consider the engineering we discussed today. They have built a unique, highly reusable, rapid turnaround air launch architecture. If they successfully prove this technology works at a high cadence, what happens to their valuation if the true endgame isn't tourism at all?
Yeah, that's interesting.
What if the real multi-billion-dollar market is high-frequency suborbital research and rapid response defense applications?
Yeah.
If they become a logistics platform rather than just a luxury ride, the sky isn't the limit, it's just the starting line. Think about that as you watch the charts.